Retail, correspondent, wholesale, direct to consumer. These are the 4 channels of the mortgage industry. Like for people who produce loans, there's 4 different ways we can produce loans. Some companies do 1, some companies do 4, all 4. Do any companies do 0? No, because it would be a company. You got it. Yeah. All right. This word that I can't spell, correspondent, it might even be A-N-T. I don't know. D-N-T, A-N-T. You want to look it up for me, Smarty? This will get tricky because a lot of times we will tell people, oh yeah, no, Waterstone Mortgage. Okay. It is 2 R's too? Okay. But we'll tell people, oh, what's Waterstone Mortgage? Oh, we're a correspondent lender. But we're not a correspondent. We don't operate in the correspondent channel. That's going to be confusing. Everything else should be pretty self-explanatory, but I want you all to understand the mortgage industry. Okay, I'm going to tell you this. I'm not going to ask questions and put people on the spot. You work for Waterstone Mortgage, and Waterstone Mortgage is a retail mortgage lender. What does that mean? That means the consumer can wake up, come into one of our brick and mortar stores, branches, and they can get a home loan. They're going to talk to one of you happy people who are professionals, and you're going to assist them in obtaining their home loan. You guys are going to have it processed, underwritten, funded, and closed by Waterstone Mortgage, right? Let me ask you a question though. Does Waterstone Mortgage keep every loan that, no, we sell a lot of our loans, don't we? We sell our loans to correspondent lenders, okay? This is where it gets confusing. Because we sell our loans to correspondent lenders, then people will be like, oh no, we operate as a correspondent. Meaning we operate as a company who underwrites funds, closes all these loans in our own name, like thousands every single month. But then we go ahead and we sell them or ship them off to a plethora of other investors. So there's a channel that's just called correspondent. That means my company buys loans from companies like Waterstone, from companies like the mortgage firm, from companies like Envoy, like big players in the national mortgage banking arena who operate in a retail channel. They have the ability to sell loans to other aggregators. It's a big word, but people who operate in the correspondent channel. When you operate in a correspondent channel, you're just buying loans. Like very, very rarely are you actually underwriting them. And you're not originating them because the retail people. So like who else operates in the retail channel that we know of? FBC does locally, right? They're a national company, but they're based in Orlando. How about Rocket?
No. Yes.
I don't know.
Yeah, I don't know.
Let's say no, because Travus, how many times have you gone out on the street and competed against a Rocket mortgage loan officer? You ran into him at a BNI or a realtor event?
0.
No.
No brick and mortar.
You say? Yeah, they don't have a brick and mortar. You know, I wouldn't really say that they do retail.
No.
But I mentioned Movement Mortgage, Fairway. How about Chase? Yeah. Wells Fargo, BB&T, Truist, US Bank. Yeah. So all of those companies operate in the retail channel, right? Just like we do. But correspondent, can FBC sell loans to Waterstone? Can Fairway sell loans to Waterstone? Can RP Funding sell loans to Waterstone? Now, I'm going to share this with you. We are only retail. All we do is retail. Dominate it. We are a unicorn in the retail. Like when we go to national conferences, people are like, oh, you guys are real? You do exist? We've seen your numbers, right? We are one of the highest retail operations that stay purchase focused, realtor, builder referred. And we stay in retail. We do it really well. We do it really profitable with really high customer service scores and really great turn times. So we in the retail channel, anyone who studies this industry, they're like, wow, yeah, you guys are the unicorn. But you can't sell loans to us, so we don't do that. Right? So Waterstone, I'd be like, nope, we don't do that. If I was like, doing a line here, right, like this, we don't do Correspondent. Now, who does do Correspondent? Well, do y'all know who some of the investors we sell loans to? Anyone been in Optimal Blue playing around yet? Not made it there yet? No? Okay, I'll tell you. Right, well, I won't make a guess. We sell loans to PennyMac. You guys know where the closest PennyMac branch is? Nah, PennyMac doesn't do retail. Okay? But we said, what did I say earlier? Chase, Wells,
Freedom?
Movement. Okay, check it out. Freedom does have a retail channel. Didn't you work there, Travis?
We don't talk about those things.
Okay, all right, but they do.
Yes.
They might not do it well, but they have it. We also sell loans to Freedom. So Freedom, we know, because Travis once worked there, supposedly, we know Freedom operates in the retail channel, but because Waterstone can sell loans and Freedom will buy them, we also know Freedom operates in the Correspondent channel. We sell loans to Wells. We sell loans to Chase. We sell loans to U.S. Bank. Right? U.S. Bank is another one. They have a huge presence in Jacksonville, so I know U.S. Bank does retail. But we don't sell loans to Movement. Right? So Movement wouldn't be on this. Trying to think of who else, but these are people who they have a silo, right? They have a business channel where all they're doing is buying loans. Normally they're buying them because they want to service loans. They might not want to own the loan. They might want to they might want to sell the loan to Fannie and Freddie, but they might want to go ahead and at least service them because there's money that you can make in servicing. All right, Wholesale. Rocket. And United. Okay, to wholesale something. That's your buddy, the mortgage broker. Your buddy, the mortgage broker, wakes up. They may work from home. They may have a small office, or usually small shops. But what does it mean to wholesale something? I'm a mortgage broker. I go out and I find Sam, and Sam wants to buy a house. All right, Sam, great. Let me get your information. And I plug it in. Let me do your pre-approval. And I do her pre-approval. And then I go, crap, I'm a mortgage broker. I don't have an underwriter. I don't have a lock desk. I don't have a funding department. I don't have the ability to actually fund this loan. Who can I send Sam's information to and ask them to underwrite my pre-approval, approve her loan, and fund it? Oh, I need to broker it. I need to go to a wholesaler. The two largest wholesalers in the entire nation are Rocket and United Wholesale. We've already established that Rocket isn't in retail, or what I would call retail. United Wholesale is not in retail either. Like, they don't want to play in that game. People don't like this game right here because it has a lot of overhead. Brick and mortar. The rent in this space is $30,000 a month. Like, that's before we get into phone bills, Encompass licensing, AltiPro licensing, right? Like, so these companies want to do loans. They love the mortgage industry, but they don't want to have street LOs and processors and loan partners that they have to like worry about and pay for. So they don't. All they want to be able to do is tell the mortgage brokers, hey, bring us your business. Now, Chase doesn't do wholesale anymore. Jamie Dimon basically said, F you mortgage brokers, you cost me billions. Because it was assumed by a company and a bank like Chase, I can't regulate you. I can't make sure you're not doing shady stuff. I can't make sure that you're violating compliance rules. And I'm buying loans, and the loans that had the most fraud were coming from my wholesale channel. Bump that, I'm getting out of wholesale. If I'm Chase, I'm gonna have my retail brick and mortar, because I already have banks, like why not? And I'm totally cool working with companies like Waterstone, FBC, Movement, and I'll just buy their loans. So Chase is like, I'll play in this correspondent all day long, because I've realized that if I'm buying loans from these larger establishments, they come with less fraud. They come with less compliance risk. And then others love it. Rocket, United. Now Caliber Home Loans, they do it all. Loan Depot, they do it all. FGMC does not do retail. And what you'll find is if you're doing wholesale, you're probably doing some version of a correspondent, right? Because what you are for these people is a outlet to deliver loans to. Whether I'm a mortgage broker and I'm bringing the loan to the wholesaler, just like here's the file and underwrite it, or if I'm delivering loans to the correspondent, all that means when it's correspondent versus wholesale, the only difference is here, this company who's allowing me to operate in the correspondent channel, they said, Dustin, you and your mortgage company are solid and proven enough that we will delegate you with the authority to underwrite on our behalf. That's all it really means, right? Like that's the main difference between do I deliver a loan wholesale or do I deliver a loan correspondent? Now let me ask you all this question. If I, Waterstone Mortgage, am delivering a loan to one of these investors through their correspondent channel, do you think that I probably have an agreement with them that if me or one of my associates screwed it up, I have to buy that loan back? Yes. Yes. Oh yeah. Oh yeah. Waterstone does $1 billion of loans this quarter, and we sell $500 million to US Bank and $500 million to Chase. Chase is going to look at our work and be like, huh? No, ma'am. I'm kicking this one back to you. Right? They have that ability. If we had a loan that went into early payment default, one of the worst things that can happen, we funded a loan and 3 months later they're not making payments. Oh yeah, it gets nasty, it gets ugly. But do you think that these companies pay us more money for our loans when they're coming to them already packaged up with a pretty bow on them because we've already underwritten them? Yes. Right? So there's a benefit to a mortgage lender to be so big that they're allowed to operate in the correspondent channel. But like the wholesale channel has more risk to these companies that operate in it. So they won't pay me as much money to bring them that loan. And all the risk is on them, right? So like Sam, you sent a loan to FGMC. The reason why you did that is because none of these people would take it. And Waterstone was like, I don't want the risk. If this loan goes bad, I don't want to have them come back on me. So if I send it to FGMC and they underwrite it, then they're on the hook for it if it goes bad. So when you start to think, well, why would we as Waterstone, one of the top 50 lenders who's a unicorn in the retail space, ever broker a loan? It's because we're saying we have to wipe our hands clean. Like we think it's a good loan, but we're not so sure that we're willing to underwrite it and put our name on it. Whereas so many other loans that we do, we're like, hell to the yeah. We're going to put our name on it. We're going to package it up in a pretty bow. We're going to deliver it to the secondary, to these aggregators so they can pay us more money for the same loan than these people would. And then DTC stands for direct to consumer, call center. Most of what back in the day you would call Rocket Mortgage, they're retail. I don't call retail anymore. I call it DTC. Better.com, RP Funding, Rocket. And many companies are going more and more to the direct to consumer. You kind of have to have it. Like, think about if you were one of these players that operate right here. Your job is to buy loans, right? Even on the wholesale, when Ziggy, the local mortgage broker, sends a loan to United Wholesale, they're essentially buying that loan from Ziggy, right? They're paying him a commission to bring Sam's home purchase to them versus Rocket or Caliber or Loan Depot. Well, when you're paying all this money for these loans and then rates drop from 4 down to 3, from 3.5 down to 2.5, you paid a lot of money for that loan. You don't want that loan to go somewhere else to refinance out. So you need to have a direct-to-consumer division that at a minimum, all they're doing is calling all of your current clients and keeping that asset in the book. Like that is their job. And then, hey, along the way, on a big refi year like last year, man, why not throw a few $100,000 at advertising? Why not get the phone to ring? I already have the call center reps there. I already have the headsets and the computer software. So you'll find that companies will operate in the direct-to-consumer channel. And that could actually be something that Waterstone could eventually probably go into that before we'd ever go into Correspondent and Wholesale. You work at a place like Rocket, like RP Funding, in Loan Depots, called AmeriSave's a huge one. Yeah, especially you're like last year, 80 to 90% of what you did was refi. Yeah, which, you know, it's great. Robert Palmer made a lot of money last year. Yeah. Right? He had some loan officers that did really well. But 2 years from now, he has to pare down his staff, has to lay off a bunch of processors, lay off a bunch of underwriters. That model is a yo-yo model. It's just one that, like, we don't play in it, but many people do in our industry. And the banks have to. If you're a big bank, you're Chase, you're Wells, you're Truist, that's the SunTrust BB&T merger, you have to play in that model. Like, which means you're constantly hiring, firing, hiring temps, third party sometimes, because you understand that this volume surge is only for 6 months. So maybe I don't go out and hire and train 20 new professionals. Maybe I offshore it to India, or maybe I kick some off to a third party like a Digital Risk, which is a local company here in Central Florida. Right? They're running businesses. So there's a business model that is direct to consumer. And you got to think about the type of professional that you're getting when you're talking to direct to consumer. You're probably not getting someone who sits through mortgage school. You're probably not getting someone that, you know, has been to a Mike Smalley coaching or possibly done a Xenix training. You know, like, it's just a whole different ball of wax. It's a churn and burn numbers game. These people, it's a great place to start. That's a good place to start, and people can make a career out of it. It's just not the career I'd choose for me or any of you guys sitting in this class. And then, like, you'll get players like FBC. FBC has a tiny little correspondent division. FBC has a tiny little wholesale division and a tiny little direct-to-consumer division, right? They dabble, you know? It's like, am I a real estate investor because I have 2 rental properties? Probably not, you know, but I'm more of a real estate investor than someone who has 0 rental properties. You'll find companies that, you know, they really dominate this correspondent space, and somewhere along the lines, they picked up a couple retail branches. So like when I said Waterstone, I could see us going into a direct-to-consumer. Why? 3 reasons. Our society is going to more of that direction, right? With technology, with people wanting to go to the internet before they go to their mom, dad, cousin, neighbor, or coworker for advice. Then if we're going to want to stay ahead of the curve, we're going to have to at least dip our toes into that scene and be a part of it. Second, Jeff McGinnis loves it. He came from it. He sees the value. And if done right, it could bring value to the branches. It could bring value to the local loan officers. And for that reason, you would do it. So I could see us getting into that. And my third reason is I think it's really cool, so I support it. Like, just personally as a professional, I've always been intrigued by the direct-to-consumer. I really think that we could use it as a way to groom the future generation of mortgage professionals, to get people in, give them at-bats, let them find their way. Some people will find that they love direct-to-consumer and they never want to get out of it. Some people will find that this was a great way for me to close 50 loans and kind of understand what the hell I'm doing, but I'm now ready to get out of the minor leagues and get into the major leagues, and I'm going to go out and build my own book of business. DTC is retail, but the industry has recently added this as a 4th channel. Okay. Yeah, you like RP funding, ready? Just because they're local. RP funding is a correspondent lender. This is where it gets confusing, meaning they deliver loans to the secondary market as a correspondent lender. They are 100% retail, but they operate in a direct-to-consumer model.
Okay, that makes sense.
Okay, yeah, that is, it can get, and like, why do I say that? Well, let's think. Can we as Waterstone sell loans to RP funding? The answer is no. Can we as Waterstone broker loans to RP? No, they don't have that channel. They don't have that channel. And I'll get really geeky on you, make your head spin a little bit. I believe I read this. RP funding last year became a TPO, third-party originator, for Rocket. It's kind of a way for Rocket to absorb a small but large local lender. And it was a way for RP, who potentially was running into a cash crunch last year during the time of COVID, that they were like, oh crap, if we don't get infused with cash, we're going to have to shut our doors. Rocket's like, hey, don't do that. You have something good going on with your direct-to-consumer. Partner with us and just start delivering us all of your loans, and in return, we'll infuse you with the cash that you need. Because when COVID hit, a lot of mortgage lenders got caught with their pants down due to how things started trading on Wall Street. Right? Wall Street freaked out. There's things called margin calls and hedges, and just know that a lot of people got caught with millions, if not tens of millions of dollars, that it's like, you owe me $10 million by tomorrow at 5. Yeah, or else I'm shutting you down. And you'll see more and more of that, where people will be operating as in fact, Rocket has a division called the Rocket TPO, third-party originating. It's kind of like being a franchise of Rocket, but you operate as RP Funding or Henkey Finance, whatever. Yep, so like RP Funding will still underwrite the loans, and they'll still process the loans. They'll deliver them to Rocket, and Rocket may even service the loan, but put an RP Funding, you might say RP Funding powered by Rocket TPO. So you think as a consumer, I have an RP Funding mortgage. No, you don't. Right? Just like I think as a consumer, I'm like, oh yeah, I make my payments to SunTrust. SunTrust didn't do my loan though. Some random B, C, D, F lender out of Kansas did my loan. They sold it to SunTrust, but then SunTrust right away sold my loan to Fannie Mae. I just make my payments to SunTrust. They are the servicer, but the owner of my loan is Fannie Mae.